All right. So are there any questions on the stuff that we covered last class? So there was some material that we went over about the equivalence of firm value under different capital structures. We looked at the example of an investor investing in a levered firm versus an unlevered firm, and we showed that those have the same payoffs. Are there any questions on how that worked? The intuition behind this result, if we remember what we've been talking about, we can consider this. Think of this problem in terms of maybe there's two identical firms. They're both two identical firms. They're both trying to, they're both trying to compete with each other, and maybe one of them wants to increase their value. One of them wants to get an edge over their competitors. They want to increase their firm value. They want to boost their stock price. So maybe they might think, okay, one way to do that would be to borrow, and maybe they would think, okay, if we borrow, maybe that will allow us to increase our value. And so you can almost think of these. We sort of frame this as being two different, like the same firm, before and after borrowing. We could actually think of this. It might help to think of this as being two different firms that both start out with the same capital structure. Maybe these two firms, both begin their lives as a company with a certain amount of assets, sort of given by this first column. They both have, they're competitors with one another, so they both are engaging in the same sorts of activities, and they both start out with the same capacity to produce, the same amount of assets. They're about the same size, and then one of them decides, I'm going to actually make myself more like this and borrow, right? So then we can consider what would happen, what could possibly happen to the stock value of a firm that decided to borrow like that, in the case that shareholders had access to exactly the same credit markets as the firm did. So we can think about that case of two firms that are initially starting out with identical capital structures, identical business models, identical amounts of assets. One of them decides to borrow. In doing so, we talked about how the firm, after it borrows, increases the spread of its earnings. It's sort of rotating this blue line. We have this blue line that represents the relationship between before interest earnings and earnings per share after interest, and the leverage sort of causes a counterclockwise rotation around this fulcrum, around this 10% earnings level, or 10% return on assets. So the leverage sort of produces this rotation. It makes the gains a little bit higher if the returns happen to be above the cost of debt. It makes the returns lower if the earnings happens to be below the cost of debt. And so that's what's happening when the firm is borrowing. The levered firm, so they start out identical. The levered firm increases its expected returns, but it also increases the variance. So then the question is, would shareholders, would investors in these two firms, would they have a preference of one over the other? And we showed with this example, we showed how this is from the perspective of, this is from an investor's perspective. We showed how the investor, if it's choosing between these two companies, it's choosing between the unlevered company and then the company that was identical before but then just levered itself up. If it's choosing between those two companies, as long as that investor has access to the same credit markets, it can actually duplicate the returns of the levered firm using equity that it purchases in the unlevered firm. So this first case was strategy A. The investor is buying 100 shares of levered equity, and it can earn $0 or $400 or $800 depending on the state of the world. The cost of that strategy is $2,000. It's spending $2,000 of its own capital in order to get that earnings profile, right? And then it has an alternative strategy. It could actually use some of its own money, but then also borrow some money. And instead of investing in the firm that had borrowed, the investor borrows and buys shares in the unlevered firm. And in so doing, this investor is actually able to exactly duplicate the returns to the strategy A, which was just investing in the levered firm. So this second strategy where the investor doesn't invest in the levered firm, but it goes out into credit markets and borrows some money, invests that money in the unlevered firm, it can actually exactly duplicate the returns that it would get if it invested in the levered firm outright. And the cost of that strategy is actually identical. So really the point there is that the firm can't possibly increase its stock price. It can't increase its value if an investor could simply duplicate the returns of those levered returns on its own, and still pay the old stock price. So the fact that those two strategies can't cost any different. If they cost different, if the levered strategy costs more because the stock price is higher, then nobody is going to choose that strategy. No one's going to choose the strategy that costs more and gives you exactly the same profile of returns. They're going to go for the cheaper strategy, which would be to borrow themselves and invest in the unlevered firm. So if it was true that the leverage increased the stock price, nobody would choose strategy. No one would choose strategy A at that point if the stock price increased, because that would increase the cost of strategy A relative to strategy B, and that couldn't persist. There'd have to be some equilibrating mechanism that everybody would pull their money out of the levered firm and invest in the unlevered firm if it was possible to get the same profile of returns at a lower cost. And so the movement of capital between those two firms would, in some sense, equalize the costs of those assets or of those investment strategies, and that would push those firms' value to be exactly the same. If one of them increased a little bit, that flow of capital from one to the other would pull down the price of the levered firm until those two are equal, because the returns are equal, so the costs have to be equal. That's the intuition of the Modigliani and Miller proposition 1. Okay. Now this is going to imply our next proposition, proposition 2. This is going to have direct implications for our next proposition. If we think about the underlying assets of the firm. If you think about the underlying assets of the firm, these are going to be the cash flows of the firm. Assets, the underlying assets, those generate cash flows. Those are going to be some pattern, some temporal pattern of cash flows, some timing of cash flows starting now into the future, and those get discounted. And so the value of the firm, the overall value of the firm, is going to be the sum of all all the cash flows. You can think of them as being indexed by T. You're going to sum all those up over some set of future time periods. Maybe this is an infinite set of time periods. And then you divide this by some discount rate. We could also think of this as just being the WACC. This is the appropriate rate at which to discount the cash flows. Right, so we can just think of this as being the WACC. So if the firm value is just given by this identity here of the cash flows which persist into the indefinite future and are discounted, if that just equals some constant value, we already talked about how with this Modigliani and Miller proposition 1, there's no way for the firm to increase this right-hand side. This right-hand side under Modigliani and Miller proposition 1, this is actually invariant to capital structure. So we just the result that I just described, sort of that arbitrage result, that says that the firm value, the overall firm value, can't be changed at all as a result of the firm changing its capital structure. Its underlying activities aren't going to be changing at all as a result of borrowing. The fact that the firm has the same activities as it did before, it's just paying for them differently, means that these cash flows are not going to be changing at all. And so that's going to imply that this WACC has to be constant. Yeah, question in the chat. This is under the assumption of no taxes. Yeah, we're still in the no tax. We're still in the no tax world in this part. Yep. So firm value is invariant. Cash flows are invariant to the capital structure. There can't be, the only thing that's changing is the financing. There's nothing changing about the firm's underlying activity. So the cash flows are constant. Firm value is invariant. That's Modigliani Miller proposition 1. By implication, that has to mean that the WACC is also invariant to capital structure. So this implies that the WACC also must be invariant to capital structure. That just comes out of this identity of the firm value being the present value of all future cash flows. If the firm value is invariant and the cash flows are unaffected by the financing structure, then the WACC also has to be invariant to capital structure. So that's the second proposition for Modigliani and Miller, where the cost of capital, by implication that the firm value is unchanged by borrowing, the cost of capital therefore must also be unchanged by borrowing. And we can actually kind of see this just with this simple example. We have a firm that is, has a certain level of risk associated with it. In the case of an unlevered firm, we have the first case where the returns are variant, about plus or minus 10%, around 15%. So there's a possibility of only having a 5% return. There's a possibility of 25% return. In expectation, you'd have a 15% return. So in order to tolerate that amount of risk, investors require require a 15% return. That's for the level of risk in the unlevered case. And we know from the capital asset pricing model that when you increase the variance or the risk associated with an asset, you have to be compensated for that. As an investor, you have to be compensated in order to be willing to take on that extra risk. And so the levered firm has a higher spread of returns. The underlying assets are still generating the same return, but the residual amount to equity, the residual returns to equity actually have a higher spread. That was essentially what was being illustrated by the this seesaw graph that we had put up. The residual returns to equity can be changed as a result of taking on that borrowing, even if the underlying activities of the firm aren't changed at all. Right. So the fact that you have the residual returns to equity being more risky, that implies that the investors are going to require a higher level of return in order to tolerate that risk. So in that case, you know, the 20% return, that's the required return for the level of risk in the levered case. So the required return increases under this new leverage this leveraged capital structure. It goes from 15% required return to 20%. And so we can just check that the WACC is unchanged under this new capital structure. The previous WACC, you know, previously we had a 15%, you know, required return for the unlevered firm. In that case, the capital structure was all equity, no debt, and so the weight that was placed on the cost of equity capital portion of this equation, this share was just equal to 1, and then the share in debt was equal to 0, and so the WACC under that scenario was 15%. Now, if we have, I guess first we can just define that WACC. You know, the WACC in the unlevered case, we can just define that as RU. We'll just consider that to be the unlevered WACC. Okay, so this is the unlevered firm, the WACC in the unlevered case. The only portion of this equation that matters is this first left-hand side term. This right-hand side term is just equal to 0 because the debt share is equal to 0. Now we can just consider what happens under some leverage. So the equity share is now equal to 4,000 divided by 8,000. Remember, assets are still 8,000, but now equity is only 4,000 rather than 8,000. So that's what gets plugged into this first part. So that becomes 1/2. The cost of that equity has increased because of the risk. It's become riskier. That residual equity, cash flow to equity is becoming more risky. That's the seesaw being tilted in a counterclockwise direction where you can have bigger gains but also bigger losses. And then the cost of debt actually hasn't changed at all, but what has changed is the proportion of the firm's capital structure that is taken up by debt. So this 20%, this just really comes from, it's kind of an equilibrium assumption. The assumption is that this firm is just pretty much doing as best as it can with the assets that it has. So the 20%, the question in the chat was where does this 20% come from? It really comes from the fact that when you leverage up, this is kind of the average return that you're able to get from your activities, and that's the cash flow that's coming to equity from that level of debt. One of the underlying assumptions of this model is that these represent kind of equilibrium returns. So if there's a bunch of different firms that are all competing with one another, they're all trying to get the highest returns possible. They're all kind of already at the efficient level of production and pricing, and they're making as much money as they possibly can, given that they're competing with other firms. This 20% represents sort of the market average market returns to equity under a competitive scenario when you take on that level of debt. So this 20% is sort of like the best that you can do given that you're competing with other firms, the best that you can do with that amount of leverage. So it's kind of it's sort of an equilibrium assumption that's like what the market as a whole would be earning, given that leverage. Another question in the chat is ROE the same thing as RS in the WAC? Yeah, so that again, that it is as long as you're in a equilibrium condition where you have a competitive environment where the sort of the equilibrium level of returns for a given level of debt is 20%. You're sort of 20% is the best that you can do. There's no one who can really exceed that, at least in the long run. And so 20% in some sense represents the expected returns to the market. And because it's the expected returns to the market, that implies that it's the cost of equity capital. It's the opportunity cost of your money. If you didn't invest in this firm, you could go and invest your money in a firm that would also be able to make 20% on their equity in the marketplace. So it's the same thing under this sort of these equilibrium conditions where the market as a whole is everybody is sort of doing as well as the market as a whole. So 20% then is the sort of the market return on equity. This particular firm returns 20%, but you could think of it like all the firms in the background who are competing in the background are also earning about 20% on average as well. And so this firm in particular has to earn that 20%, or else it's not going to be able to attract any capital. So in equilibrium, this is the ROE equals the RS. So that part gets multiplied by this 1/2, for the capital structure of equity, and then the debt share that debt share is also represented here on the right hand side of this equation. The cost of debt is still 10%. There hasn't been any changes in credit markets over this time. So you end up with 1/2 times 20% plus 1/2 times 10%, and that ends up to be 15%. So the RS has increased to 20%, but overall the WAC is still unchanged, mainly because the underlying value of the firm is still the same, and in particular the firm has had to make up for its leverage by earning a higher expected return, because the risk associated with those returns on equity is a lot higher. It's got a wider spread for its returns on equity, and so to be compensated for that, investors need to have higher levels of return. And on average, that's going to just keep the WAC identical. So you can think of it from this perspective, where you can look at the average returns on equity and how they change. You can plug in the equity shares and the debt shares and see how that gives you the same overall WAC number. You can also think of it just in terms of this identity that I had written down right here, where if you believe that Modigliani and Miller Proposition 1 result, that the firm value can't be changed at all by the amount of debt. That the financing is not inherently changing anything about the firm's activities. Its cash flows are still going to be doing the same things as they did before. And then by implication, the rate at which you're discounting that, if it's the case that the firm has the same overall value, then it's the case that the WAC must also be invariant. So each of those approaches sort of implies the same thing. Either looking at it this way implies the same WAC, or looking at it from this perspective of putting in the the new cost of equity that's required under the leverage, and solving for WACC under that new capital structure. That's an alternative way of seeing that these costs of capital have to remain the same under different amounts of leverage. One of the ways that we can figure out what this return on equity needs to be is actually if we just assume that, so we have WACC being invariant to capital structure, so we can just consider this as being equal to some constant. We can think of it as being the if it's invariant, if the WACC is invariant, it's equal to a constant. Therefore, we can substitute some number in for WACC, and it's helpful to substitute the number that would represent the WACC in the case when there is no there is no leverage at all, in the case of an unlevered firm. So this is the unlevered cost of capital. Now, if this unlevered cost of capital is equal to what we had before, what we had expressed the WACC equation as before, we can rearrange this equation. And there's actually, if we go to I won't work out the algebra right here, but if you go to page 496 in the textbook, go to page 496 in the textbook, and it's like, I think it's footnote number 8. It actually works out the algebra that goes from this equation 1 to equation 2. But that's just a simple rearranging of that WACC equation, and it turns out that we can express the cost of equity capital, or this this required return. We can express that as a function of the unlevered cost of equity, and then adding that to the difference between the unlevered cost of equity and the cost of debt, and then multiplying that by the debt to equity ratio. That gives you the required return on equity, or the required return on equity capital under any debt and equity structure. So that's the expression for the cost of equity capital for any new capital structure, as a function of the cost of debt and as a function of the cost of the firm's underlying cost of capital given by the WACC or given by the unlevered cost of capital. So if we just plug that in if we plug in the numbers for for this particular problem, we have the unlevered cost of equity was 15%. We have a 5% gap between the cost of unlevered equity and the cost of debt. We have a debt to equity ratio under this new capital structure that is equal to 1. So the debt in this case is equal to equity. And then, as according to this equation, we work that out, and we get this 0.2 number, which is the 20% expected or 20% required return on equity that we had seen in the previous case, where that was the amount of return to equity that was expected under that new leverage scenario. So that equation checks out with our experience in that previous example. Right, so that's the relationship between unlevered equity and levered equity capital. Everything we've done so far is in the presence of, or sorry, it's in the absence of taxes. Everything we've done so far is assuming that there are no taxes. This is all no taxes world. We're going to see next again, in theory, we're going to see next that the presence of taxes is going to affect the value, the underlying value of the firm. We talked about how MM1, the Modigliani and Miller Proposition 1, asserted that there was no ability for the firm to increase its value as a result of changing its capital structure. We've already seen this a little bit in the past, but we've specifically seen the way that taxes affect cash flows to the firm insofar as the interest payments on debt represents tax savings. The interest payments on debt represent interest that you're able to deduct from your pre-tax earnings, and that allows you thereby to decrease the taxes you're paying, and therefore your after-tax earnings, your after-tax income actually goes up. And that's exactly what happens in the presence of taxes, and that's the way that the underlying firm value can be changed as a result of taking on some more debt, which lets you deduct these interest payments. So this comes down to the idea of debt. The way that you finance these underlying business activities, doesn't affect the actual things that you do. It doesn't affect how you are deploying your assets, but it does affect how you are paying for those assets. And in particular, it creates a tax shield. Right. So this is the fundamental thing that's different about financing with debt as opposed to equity, is you're able to take advantage of this tax shield. And what that's going to imply is higher cash flows, after-tax cash flows, I should say. And then, that's going to imply, higher value. So that's kind of the pathway by which debt increases the value of the firm. It's through this tax shield characteristic. So we can just remind ourselves of kind of a simple income statement to see how this works. So we have a firm that has underlying amounts of earnings before interest and taxes. That's $110. The EBIT is $110 before interest and taxes. Let's say that this firm is borrowing $100 at a 10% annual rate. The interest that's being deducted here is the 10% of the $100 that was borrowed. The underlying activities of the firm are the same. The interest is deducted, so the after-tax income is $100. In the case of a firm that has debt, the pre-tax income without debt is $110. Once taxes are assessed on that pre-tax income, the taxes actually go down by $4 in the case of the firm borrowing. And so the net income after those taxes are deducted is 60 in the case with debt, 66 in the case without debt. But the total amount that's available to investors, under each of these scenarios is $4 higher in the case with debt as opposed to the case without debt. Essentially, the government has taken less of the firm's money in the case with debt as opposed to without. And so this $4 represents the sort of the tax shield effect of that debt. The firm with debt is paying less taxes than it would otherwise. And this is exactly the phenomenon that's going to cause the total firm value to essentially go up after debt is being issued. So we can think about this as being, you have some firm value. We talked about how this unlevered firm value was equal to the levered firm value under Modigliani and Miller, Proposition 1, with no taxes. In this case, there's going to be some gap. We're going to have unlevered firm is going to be actually less than the levered firm with taxes. And then the question is how much? What's going to be the change? The actual difference in the overall firm value is simply going to be the present value of the tax shield. So there's this tax savings. We've seen this on our previous exercises. We've seen this on I think it was exam 2. There was a problem with one firm that had issued a bond, another firm that had not issued a bond, and the firm that issued the bond is paying less taxes than the other. That results in more cash for the firm over time. If the firm is keeping that debt on its books over the long run, that's going to add up over time and end up being a significant addition in firm value. And so the annual value of this tax savings, it's going to be the tax rate times the amount of debt times the interest rate. That's the amount of tax savings that's going to happen as a result of that borrowing. We saw that here where we have the amount of debt is B equals 100. The tax rate was 40%. The interest rate was equal to 10%. Right, and that ended up to be $4 worth of interest tax shield. So that's the amount that the firm is saving annually. That's the annual tax savings. And then if that occurs over time, if that occurs every single year, then you want to calculate the present value of that. So you take that amount, and in this case, you discount it by by the rate that corresponds to the same the same level of risk that's associated with the cash flow. So the level of risk that's associated with this is given by just the interest rate. The interest rate is capturing a certain amount of risk. It has a certain risk built into it, just as the cost of equity capital has a certain amount of risk built into it. And so the appropriate, if we remember that tax rate, if that's the annual interest or the annual tax savings, if we divide this by the appropriate rate, to get the PV, the present value of the perpetuity, then this represents the PV of that represents the PV of those tax savings, which ends up being you're able to cancel out the cost of debt in the denominator, the cost of debt in the numerator, and that PV of the tax shield ends up just being the tax rate times times the amount of borrowing, right? And so that's going to be the difference between what the value of the firm is in an unlevered situation and what the value of the firm is in the levered situation. All right, so this is going to then lead to the changes in capital structure, changing the value of the firm, and thereby changing the relative amount of equity that's left over after certain amounts of debt have been taken on, or certain amounts of debt have been issued by the firm. It's going to affect the firm value, and then that in turn will affect the relative proportions of the firm that are taken up by debt and equity. So that's the next stage of this, is to consider each of these firm valuation and cost of capital amounts in the presence of taxes. So that's what we're going to cover next. This is what the homework assignment, homework 9, deals with a little bit. The Canvas problem in particular deals with this problem of figuring out the firm value under taxes, and then figuring out what the firm's new cost of capital is. I think we're probably going to try to wrap up that content on Friday. So come back on Friday for the rest of that, and that'll be handy for homework 9, which is due on Monday the 20th at midnight.